On the Express this week, week 3 of the government shutdown and no end in sight. Why Jamie Dimon is worried about cockroaches. Investors keep skating on Golden Pond. Ric Edelman drops in for a reality check on our future, the Investopedia indicator, and what to watch this week. Microphone check 1, 2. What is this? It's the Investopedia Express, and it's time for business. Welcome back and welcome aboard. Welcome to all of our listeners and watchers and followers all over the world. We know you're out there from Canada to India, right here in United States of America and beyond. Thanks so much for joining us on a Monday morning here. Coming into week 3 of the government shutdown. No end in sight, though. Some talks this morning about maybe there will be some negotiations this week. There's a lot riding on this right now. But week 3 of the government shutdown, we're about day 20. The longest in history was 35 days. Back in 2018. We'll see if we get there now, but there doesn't seem to be any end in sight because there's a real stumbling block here between the two parties. So the Republicans are pushing for what they call a continuing resolution, which would open the government at current budget levels, but Democrats do not want to budge on this deal to not extend healthcare subsidies that will expire at the end of the year. We talked about it last week. Those are the Affordable Care Act tax credits that a lot of people, millions of people, have been depending on since 2021. If those go away, we know health insurance prices that were already set to rise are going to rise a lot more. Super important as we go into open enrollment season here. But in a recent survey, 89% of Americans say they believe the shutdown is at least a minor problem. 54% say that it's a major problem. They hold both parties responsible, and that means nobody really has an incentive to cave in. But we do know, and we've been asked this question a lot, at what point does this actually have an impact on the economy? At what point does this really cause a slowdown? Well, we know from past shutdowns, these usually take about a 0.5% of GDP off per week that the government is shut down. I think that might sound a little bit aggressive, but you have to watch this. If more people, more government workers are furloughed, if those turn into actual layoffs, if government contractors have their projects paused, if they get furloughed and they lose paychecks, that becomes a problem. One missed paycheck is actually a problem. A whole cycle of missed paychecks, a month of missed paychecks, that's a crisis for many Americans living right there on the edge, paycheck to paycheck. So if this turns into much longer than expected or much longer than the last one, and there are more people involved with either furloughs or layoffs, and this administration actually goes forward with its word to lay off some government workers permanently because of this could turn into a major economic problem. But right now, stock market investors are looking way beyond this. But last week, they got a little bit scared. Regional bank scare last week popped up. We were talking about it at the end of last week's show. We were talking about the concerns about this automotive conglomerate that had some bankruptcy issues and that was playing funny with the numbers. Well, that turned into a big scare for regional banks last week. 2 regional banks last week talking about potential faulty loans. One of them, Zions Bank, associated with the First Brands that we talked about last week, Zions Bank Corporation, regional bank down in the Midwest, and Western Alliance Bank Corporation, both talking about loans that were bad or either fraudulent loans that cost them millions of dollars on their books. That put a scare through regional bank stocks last week. For a couple of days, those stocks ended up bouncing back. But usually, as we said, when there's smoke, there's fire, or as this could be an isolated incident because the stocks in regional banks did bounce back last week, but not if you listen to what Jamie Dimon has to say. He had obviously nothing to do with this last week, but that's not what he thinks. Here's what the CEO of JP Morgan Chase said about incidents like the ones that are popping up in regional banks with these faulty loans. There's a lot of interesting stuff going on there. Let's listen to the CEO on the earnings call last week when asked about it.
My antenna goes up when things like that happen, and I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one. And First Brands,
Yeah, when you see one cockroach, there's usually more, and that's what he's worried about. And how many other people are worried about that? Seems like there's a lot of frothiness out there in the economy and in the capital markets. And when you start to hear about one bank, two banks, regional banks having issues with customers that they've been doing business with for a long time, you got to worry about more cockroaches under the cushion. And that's what Jamie Dimon was saying last week. But the tug of war between risk on and risk off behavior in the stock market across the capital markets, that continues as gold continues to make new highs. Gold's just been on a rocket ship all year this year, up 68%. But actually, if you think about it, and if you actually do the research like our friends at Bespoke Investments did, gold has actually been outperforming the stock market since this bull market began back in October of 2022. This is a classic example of risk on and risk off mentalities among investors. Some investors clinging to safety, the safety of gold, the safe haven asset, while the stock market has been on an absolute tear over the past 3 years, driven a lot by what's happening in AI, about the big build out there, and about some of the biggest stocks in the market, some of the biggest companies in the market producing incredible returns over the past 3 or 4 years, really since October of 2022. But gold has been outperforming stocks by about 60 percentage points. And that is not something you often see during a bull market, but that's what's up. And when you look at gold's rise and you measure it against the dollar, they've always had an inverse relationship. Gold versus the dollar representing, of course, the dominant currency on the planet. It's the means by which we transact. It's legal tender. It's the basis for all transaction and conversion, or most of it, but it's also a full reflection of the faith and credit of the republic. It says so right on the dollar bill. Meanwhile, gold is that safe haven asset, and that safe haven asset is what a lot of investors, especially big institutional investors, central banks, even retail investors have been clinging to, because a lot of people just don't believe in the hype behind this rally and behind all this melt up in the capital markets that we've been experiencing so far for the past really couple of years right now. When you look at this year, though, when you look at the top performing assets this year, this tells you all you need to know. Number one on that list, it's gold. It's gold, up 64%. And then EAFE stocks, that's outside of North America, right? That is markets, emerging markets and foreign markets outside of the United States. That's up 27%. Emerging market stocks are up 25%, convertible bonds up 20%, and the NASDAQ 100, driven by some of the biggest stocks in the market, that's up 18%. Classic example this year of a risk-on, risk-off mentality among some investors, some who are going all in, who believe in the rally and believe in this huge build-out we're seeing, and the continued expansion and spending on AI, and those that aren't, and those that have a lot more doubts about the future of the global economy, the future of what's happening here in the United States, and they have been clinging to gold. It's been a fascinating year. All right, let's get into it with our good friend, Ric Edelman, who joins us on the drop-in just around the corner. So good to see you, my friend. For folks, if you don't know Ric Edelman, he's one of the most influential and important financial advisors and educators in our industry. Full stop. He's a best-selling author of many books, including The Truth About Your Future. You got a new one coming out, The Truth About College. We're going to get into that in a minute. You created and hosted the first financial advice radio show, Ric Edelman Radio. That ran for 30 years. The co-founder of the Digital Assets Counselor for Financial Professionals, a philanthropist, a futurist, the best friend any investor could ever have, and a very good friend of mine. So good to have you back on the Express, Ric.
It's always a pleasure, Caleb, to be with you. Thanks so much.
Well, you got a new book coming out called The Truth About College. This is really a part of your series about the truth of ... And you've really taken to this over the past, several years, educating investors, consumers, everyday people about really what's happening in the future of finance, because things have done change, and you've been all over that change for a long time. So I want to get into some of these themes, Ric. We'll talk about the book, The Truth About College, that's coming out shortly here. But I want to get into it by looking at the price tag that Investopedia has put on the American dream. And then I want to talk about the future of all the things that are associated with it through your vision and through the way that you've been working and doing research over the past few years, because I've learned so much by listening to you. So let's throw up that chart. We recently priced out the American dream, if you want the things, the basics, right? Not the needs, the wants, at around $5 million, which includes, Ric, $1.6 million for retirement. This is money you have to accumulate over your working life, right? 25 to 65. Premium healthcare, good healthcare, $414,000 or so. Owning a home, $950,000 plus. Raising kids and sending them to college. I definitely want to get into that with you. But let's break it down, starting with the retirement part of this, because you've basically educated and created a company that provided retirement services for millions and millions of Americans. That number seems low to me. And given the work that you've done on longevity and how long we're living, What does it seem? How does it seem to you?
Yeah, I agree with you, Caleb. The number, as scary as $1.6 million is, because most Americans have no shot of accumulating it, but as low as that number appears, or high to some folks, it's way too low. Because we know that people are living longer than ever. The big issue that is not being talked about, the so-called elephant in the room, is longevity. We already know that life expectancy at age 65 is 87. And by the time you are 87, it's going to be 100, because of innovations that are continuing to occur in medical technology, nanotech, biotech, bioinformatics, and more, not to mention, of course, AI and robotics. So we need to recognize we're going to live a really long time in retirement, and that means we're going to be spending a lot of money during those years, and you need to make sure that your money lasts as long as you do. So $1.6 million accumulated for retirement is probably a low target. You probably are going to end up needing more than that. And yet we know at the same time that the average American who's 50 years old has less than $250,000 in their 401k. So Americans are woefully underfunded when it comes to retirement planning, and we need to start paying attention to this and focusing on it.
Yeah. And I know just from talking to you and listening to you over the past few years, it's not only that we're underfunded, we also might be in the wrong investment vehicles or riding in the slowest part of the train, given the advice we've gotten from the financial services industry over many, many years about being on the glide path, being on that 60-40 portfolio, easing up as you get a little bit older. Take us through why that doesn't work anymore.
Yeah, that's exactly correct, because not only are Americans not saving enough money, more importantly, as you just said, Americans are saving in the wrong place. And that's because most folks pay most of their attention to risk. Comfort level. I don't want to run the risk of losing money. I don't like volatility. I'm afraid of the stock market. And as a result, they put most of their savings in super safe places: bank accounts, CDs, money markets, T-bills. Those assets simply don't earn the rates of return necessary to get ahead of the inflation and tax curve. We have no choice but to invest our money where we have the potential, not necessarily the promise, but the potential of earning the kinds of returns that are necessary to truly create wealth. I'm talking 8, 9, 10% annual returns. That's what the stock market has produced over the past 100 years. No reason to think it won't continue to produce that over the next 100 years. And not only stocks, but nowadays we can add crypto to that conversation. The newest of all asset classes, now 15 years old, many considering it to outperform over the next decade as it has over the past decade. So we need to recognize it's not just how much you save, it's where you save that's going to determine your future financial security.
Yeah, you and I have had a lot of conversations about this, but you've actually been on this for over a decade. It's not like you just came around to cryptocurrency and Bitcoin. And you say, and I listened to the last few episodes of your tremendous radio show and podcast over the weekend, just to kind of familiarize myself. You say you can't afford to not be invested in crypto, no matter how risky you think it is, if it is not a part of your portfolio. And you're not talking about 50%. You're just talking about having it in there. Then you've probably done yourself a disservice. Why?
Yeah, there's no question about it. I mean, let's put it this way. If you believe in simply owning the market, and that's what most folks do these days, they're passive investors, they believe in diversification, makes a lot of sense. Well, if you look at the value of the stock market, the value of the bond market, and the value of the crypto market, what you discover is that the total value of those three things is right now about $120 trillion. Crypto is about 4% of that, about 3% of the total value of America's assets, which means if you believe in owning a diversified portfolio, you should have about 3% of your money in crypto. And if you don't, you're essentially making a bet that you don't think crypto is going to rise. You're essentially shorting the crypto market. I don't think that you're trying to make that kind of a bet. You should have 3% of your portfolio in crypto simply as a default. And yet most Americans are not doing that.
Yeah. Most Americans, well, still feel like it's super risky, although the gate has been opened. This administration has kicked it wide open. You said it was going to happen. You and I have been talking about this for a couple of years. When this administration was put into office, you said the gate's going to be open. This is going to become institutionalized. It's going to be in our 401ks along with other assets. You're absolutely right. That's exactly what's happening right now. Now that it is open, now that we are going to have access to these assets, how should we treat them? You say a 3% allocation, but how does a retail normal investor who doesn't understand all this say, okay, I want exposure. How should I get it?
Well, here's the thing. You don't have to understand this. I mean, you don't understand the principles of internal combustion, but you know how to drive a car. You don't have to understand how to pick stocks. All you got to do is buy a stock ETF or a stock mutual fund. In your 401k, you have a wide variety of mutual funds available to you, and you invest in those in a diversified long-term fashion, contributing with a little bit of your paycheck every time you're paid every 2 weeks. And that's simple, easy, affordable, and automatic. It's a no-brainer. And this is why most people are participating in their 401ks at work. Historically, over the past decade, 401ks have not been allowed to offer crypto as an investment option. The Trump administration has opened that door. And over the next year, you're going to see crypto as an option in 401ks. We now have Bitcoin ETFs. We have Ethereum ETFs. We have crypto ETFs that invest in companies that are building out this blockchain technology. In other words, you have a thematic ETF, just like you have computer ETFs or commodity ETFs or bond ETFs. Now you have crypto ETFs. Simple, easy, cheap, liquid, transparent, and a great diversifier for long-term investors. So you're going to see for the very first time, thanks to the Trump administration's policies, widespread availability. JP Morgan, Morgan Stanley, Merrill Lynch are all going to be offering this, along with Wells Fargo and every other major bank. Schwab, Fidelity already make these available to their customers. You're going to see this available by everybody everywhere in convenient, familiar packaging of ETFs. It's a no-brainer. And this is why you're going to see a significant rush of assets into this asset class. And as the more people invest, as the more money flows in, the higher the prices go.
Yeah, especially with Bitcoin, which has a limited supply, we know. And I've also heard you say this: if you're working with a financial advisor or planner, and you should, once you get to a certain level, and they're not willing to have this conversation, time to break up with them, right?
Yeah, I really do believe that. In fact, 62% of investors say that. They say they're willing to fire their advisor in favor of one who is familiar with crypto. And the advisory community knows this. They realize they're behind the curve. They have been ignoring crypto, they've been oblivious to it, many have been opposed. But now, under the Trump administration, allowing banks, brokerage firms, custodians, asset managers to participate, we're seeing institutional investors engage in an unprecedented way. And this is why Wall Street is racing to catch up. So financial advisors are busy getting the education they need. That's what we do at the Digital Assets Council of Financial Professionals, DACFP.com. We're the preeminent educator in crypto for the financial services industry. And we're doing an awful lot of work training them, getting there what we call the CBDA designation, certified in blockchain and digital assets. So there's no excuse for an advisor not to be able to know about this, no excuse for an advisor not to be able to help you with this. You don't need to become the expert. You just simply need to hire the advisor who's the expert. And that's increasingly easy to do.
Yeah, and there's Jay. He likes that. Says good stuff, guys. Wanda also chiming in. She likes that. Let's go. She says, "All right, let's get back to the dream for a second. The home part of this." There's Wanda. Let's go. The home part of this, costing potentially $1 million over the course of a lifetime, depending on where you live. If you live in certain parts of this country, good chance. Good luck getting $1 million home. But the fact that this requires so much investment on our part, and there is something to owning a home in terms of diversification, the emotional connection we have to owning a home, which is important. We raise our families, we have birthday parties there, we gather around the kitchen table there. It's important to us. Doesn't appreciate like the stock market does. But talk to us about home ownership and the concept of building out a financial future for somebody thinking about real diversification.
It's really important to be a homeowner in America. It's part of that three-legged stool. Home ownership, because the value of the house rises over decades, investments, and Social Security and pensions. Those are the three-legged stool. And if you remove one of those legs, such as not owning a home, well, you're denying yourself one of the key elements of wealth creation over time. And this is really important. So it might look scary, oh my goodness, owning a home costs nearly $1 million. Let's keep something in mind. This is the lifetime cost, meaning you get to live in the home while you're paying for it, which means it's your income from your career that allows you to afford this. You don't have to come up with $1 million all at once. You don't have to accumulate it by the time you retire. It's something you'll do along with your earned income over time. Now, we know home prices are the highest ever. The average is over $400,000. We know that it has outpaced salary increases over the past couple of decades. And we know as a result, young Americans are struggling to come up with the cash needed to be able to get into that house. We need to get creative. We need to get serious. You need to recognize if you're in your 20s or 30s, home ownership matters. It'll really pay off for you in future financial security. And don't be daunted by the fact that it is going to cost a lot of money, because it's equally going to represent a significant amount of your wealth in the future.
Yeah, that's part of you investing in yourself and building a big asset base. So not for
Exactly.
everybody, but for those thinking about it, certainly it's been a path to wealth creation over time. But it, again, doesn't appreciate like the stock market. But that's not the point. You got to live someplace at the same time. Let's get into college and the cost of college, because you have a terrific new book coming out, The Truth About It, which those of us that have kids in college know it's a pretty painful truth when you have to write that check. Although it is an honor, but you have taken this apart in a pretty healthy way in this forthcoming book, because of the ever rising price of college, but also because of the way this just system seems broken right now and the demographics of our country. Get into it.
Yeah, this book does not bash college. It's not an anti-college book. We all know that college is broken, as you said. It costs too much. We know that so many students fail to graduate. We know that there's massive student loan debt, $1.8 trillion. We owe more to college debt than we do credit cards at this point, and we know the problems. But having said that, college still remains the best path for most kids. We know that most households that are highly successful are headed by a college graduate. We know that college graduates make a lot more money over their lives. We also know that they live longer. They live healthier lives, longer lives than people who don't go to college. So there's a lot of benefit. But at the same time, it can be perilous, because we know that 24% of freshmen drop out and only 62% graduate after 6 years. And that 20 years later, people are still paying off their student loan debt. This is a crisis. In other words, it's not the problem that kids are going to college. The problem is they're going to college the wrong way. They're choosing the wrong school, or they're choosing the wrong major, or they're transferring to a different school where they lose 40% of the credits they had earned. And as a result, they're taking too long to go to college. They're spending too much for it. They're choosing the wrong major, which hinders their ability to enter the workplace. They're not earning enough money once they graduate, all because they're going about it the wrong way. And that's what my book, The Truth About College, is aimed to solve. It shows teens and their parents the issues confronting you in college decision-making today and how to make the right choices. Most importantly, I show you how to graduate debt-free on the dean's list in 4 years, ready to enter a career that you really want to work in. And that's the message that most people have not been able to figure out. And I share it all with you in The Truth About College.
Yeah, and this is myth busting, but it's also really giving people the actual facts, the realities of what's happening today. And a big part of that is I think when you and I were coming up, it really mattered, or it seemed to matter, in the industries we wanted to get into, where you went, who you knew, what sports did you play. There was this, familiarity bias all over the place. But now employers care less and less about that. And that ties into something that you're super passionate about, which is this exponential technology that is happening around us right now. I think employers care less about, what fraternity and what Ivy League school you went to, versus, can you code that and make our processes more efficient? Get in. Why are these two things meeting head on so important right now for families considering college educations?
You're exactly right, Caleb. It's not so much about where'd you go to college, what degree do you hold. The question is, can you do the work? Do you have the skills? Do you have the knowledge? Do you have the experience? And employers are less interested in college and more interested in, can you do the job? And this is why we need to recognize that college is the wrong path for an awful lot of students. We need to recognize that there are alternative approaches, such as going into a certificate program, which you can get in a matter of months, or an apprenticeship. There are more of them than have been in the last 100 years, where not only do you not have to pay for it, they will pay you a salary while you're in it, and then they'll give you a job once you graduate. So this is a wonderful example that there are now new, different ways to go to college. There are dozens of states that offer free college educations. There are companies that will pay for your college degree. Everybody is recognizing it's not about the degree, it's about developing the skill set to be able to perform in the workplace. And that is a different focus than people have had when facing the college decision. And I make it all really clear. One statistic, I think, says it all. In my research, I was astonished about this. 37% of US post office mail sorters have a college degree. This is insane. There's no requirement that mail sorters have a college degree, but 4 out of 10 of them do. It means that they didn't focus on what kind of major they should be choosing. They chose a major that obviously didn't lead to the career they were hoping. They spent 100,000 or more and 5 or 6 years of their life getting a degree that didn't help them get a job. That is a huge disservice to them as well as to all of America. We need to recognize that there's a specific path you should follow, a choice to make whether or not to go to college. And if it's the right choice, how do you choose the school and the major so that you emerge genuinely better off? Otherwise, college could well ruin your life. That's what we need to recognize today.
Yep. That's it. You're not getting the ROI, but to your point, there is a way to do this the right way, and you don't have to spend $300,000 to get it done. You got to be realistic about it, and that's what you're so good about doing. All right, let's go out on this, and I'm gonna have you on again, and we're gonna do a whole episode on this. But I'm fascinated with the tokenization of everything, and you've been all over this from the jump. The fact that there are new stock exchanges opening, one in Texas that is really going to trade tokenized assets 24/6, right? Almost never going to stop trading, and that there is this new securitization and tokenization of things that we have held sacred for years and put assigned a value to: stocks, commodities, treasuries. You can now tokenize these things. What do you mean by that? And what does it mean for the individual investor, the individual passive investor that's been trying to do the right thing by investing in index funds or ETFs or single stocks or treasury bills? The fact that there's going to be this other digital world. Explain it to us, and how should we deal with it?
Yeah, tokenization is the most exciting element of crypto, and it's coming. And the good news is you're not going to have to worry about it or pay much attention to it because it's simply a platform. It's going to be a back office technology that will simply facilitate your ability to buy assets. In other words, we know what a share of stock is. That share represents your ownership in the business. You own one share, you own a tiny piece of the company. That's what a token is. A token is a representation of your ownership of an asset. So just as we have shares of IBM or shares of NVIDIA, you're going to have a token of NVIDIA. And that token will trade on the blockchain. And because of that, it'll trade 24/7. Settlement will be instantaneous. Instead of having to wait a whole day for that settlement to occur, that's what we have today called T+1. That settlement will be instantaneous. Like when you buy bread in a supermarket, you buy the bread, you walk out of the store with it instantly. You'll do the same thing with your stocks and your bonds and your commodities and your gold and everything else. So tokenization will make transactions faster. They'll be 24/7, 365. They'll be more transparent. And here's the best part. We can tokenize anything. Not just stocks and bonds, we're going to be able to tokenize real estate, artwork, rare coins, exotic cars, every kind of asset class, baseball cards, memorabilia in sports, all of it will be able to be tokenized. In other words, instead of 15 or 20 asset classes like we have today, there are going to be 15 or 20,000 asset classes. Every financial asset on the planet will be a token, and that will create diversification like we've never seen. You'll have the opportunity to invest in commercial real estate that ordinary investors really can't do today because real estate's really expensive. It's $1 billion building. It's also illiquid. How do you sell real estate? Not easy to do. But if it's a token, it can be done really inexpensively. A token can be $10. It trades on the blockchain where you have instant liquidity all the time. This is going to create new markets for ordinary retail investors, broadening your diversification, creating the opportunity for better returns, lower risk, greater transparency, lower cost. What's not to love? In fact, we're going to go beyond that, Caleb. Not only are we going to tokenize assets, we're going to tokenize information. Your driver's license will be a token. Why are we carrying a piece of plastic in our pocket or purse? Instead, it'll be a digital asset on your smartphone. We're going to do that with your driver's license, your passport, your medical records, your employment records, your education records, your deed to your house, the title to your car. Everything will be tokenized. It'll be a digital asset that you can store safely on your phone. You can transmit to someone who you want to have see it, who can see only the part of the information that is necessary. It's going to be faster, safer, cheaper, greater transparency with better inclusion for everybody on the planet. Tokenization is going to revolutionize global commerce, and it's going to be fully in place by the end of the decade. It's coming quick.
Yeah, it's coming quick, and you've been you've seen it on the horizon for many years right now. So you kind of answered the question, which is, in a way, what does a modern or a future portfolio look like for an individual passive investor? Again, that's not trying to outsmart anybody, but just wants to do it right. There are so many assets right now. Meanwhile, there's fewer and fewer stocks that are being listed every year, but there's the rise of all these other asset classes and the ability to access them. So what does a future portfolio look like for an individual investor?
Exactly. In other words, have you really noticed that your financial advisor only recommends stocks and bonds because those are the only securities available for them to recommend? They don't recommend real estate because they aren't securities. They don't recommend gold because that's not a security. They don't recommend baseball cards or comic books or artwork because those aren't securities. But once these assets are tokenized, they do become securities. They do become available from your financial advisor, which means your advisor will be able to broaden your diversification as simply, easily, and inexpensively as they do today with ETFs. It's going to make your advisor more valuable because they'll be the experts helping you figure out what should your asset allocation be, how much of your money should you have in baseball cards versus gold coins or rare stamps. This is going to broaden your diversification. It's going to increase your return potential while reducing your risks, and it's going to make it easier than ever for you to achieve your financial goals. It's going to get very exciting. It's great news for not only investors, but investment advisors.
Yeah. So I assume you're bullish on the industry itself of investment advice, something that you actually grew up in, established a wonderful career, and have taught so many advisors along the way. Ric Edelman, the truth about your future, the truth about college, the truth about everything that matters to us in our futures and our financial futures. So good to have you back on the Investopedia Express, my friend. And we will link to all your good stuff in the show notes. Folks, you got to look at the archive of all the great radio shows, plus his books, plus what you're doing at the Digital Assets Council for Financial Professionals. Thanks so much for joining us, Ric.
My pleasure, Caleb. Thank you.
All right. I always learn a ton when I talk to Ric Edelman, and you see why. That man knows a lot, and he has been around this industry for a long time, seen a lot of these things coming. So we will make sure to link to all of Ric's great stuff in the show notes. Make sure you follow that and pay attention and download some of that. Also follow him on social media. He's always dropping great knowledge for individual investors like us. All right, let's look at a little money in motion right now. Again, week 3 of the government shutdown. No end in sight, though. Some bubbling up this morning that maybe we get a little resolution or at least some conversation this week. That would go a long way. But if you look at Polymarket is the prediction market where you can actually make bets on just about everything. Now, a lot of investors are betting on the fact that the shutdown is going to last longer than the last shutdown, which was 35 days. Those bets have been rising over the past several weeks as investors are actually betting on that. And if you look at Polymarket right now, and just remember the fact that the New York Stock Exchange parent company, ICE, made a big investment in Polymarket just a couple of weeks ago. There's the length of the shutdown there. A lot of people think it's going to last for a minute, 30 plus days. But if you look at Polymarket right now, odds of the government shutdown ending October 23rd to 26th are 29%. The odds of it ending next week are 13%. So they think it's going to go a little bit longer, but you can literally look at prediction markets for just about everything on Polymarket right now. The Bolivian presidential election, the next Fed decision, Russia, Ukraine, will Tesla beat its earnings? Polymarket joining the capital markets through that big investment from ICE. It's a fascinating world out there. Ric touched on it, but the fact that you can really bet on anything, that's pretty intense as well. All right, let's get set up for the week ahead. Look down the tracks at what's coming up because we got a busy week coming our way, chock full of earnings and other economic reports. Let's see what's on the docket for this week. Yeah, another busy week facing investors. We got a ton of earnings coming our way this week. And this is a week we were supposed to get some government reports, some pretty important government reports. We're probably going to get that inflation report for the month of September released now a couple of weeks later on the 24th. But as far as the rest of the week goes, today, leading economic indicators were supposed to be released by the Bureau of Labor Statistics. I don't think we're going to see those. But coming up tomorrow, big day for earnings on Tuesday, October 21st. We got Netflix, we got Coca-Cola, we got Philip Morris, we got 3M and GM among those companies reporting results tomorrow. Wednesday, big reports coming out of Tesla, SAP, IBM, GE Verona, one of the top performing stocks so far this year, and Lamb Research on Wednesday. Thursday, I should say, existing home sales, if we get it, coming out for the month of September. Existing home sales have been flatlining for a very long time, although we're starting to get a little rumblings in the real estate market. And then earnings on Thursday from Intel, Union Pacific, the big railroad, reporting results on Thursday, BlackRock and Ford on Thursday. And then Friday, again, maybe the CPI report, the consumer price index for the month of September that was supposed to come out a week and a half ago or a week ago. Maybe we finally get that on a delayed release from the Bureau of Labor Statistics, which isn't a government shutdown right now, plus earnings from Procter and Gamble. And when you look at the stock market right now, you look at the argument that everyone says it's not really the S&P 500, it's the S&P 10. Our good friends over at Carson Research, Ryan Dietrich and Sonis Varghese, always coming out with the smart charts. I'm citing them all the time on the show because they make me smarter every time I look at it. They pointed out to a pretty important chart. The Magnificent Seven have made a big contribution to this bull market and to the big rally we've had. Everybody knows that. You always get concentration in key parts of the market that are growing. And that's what happens in every era. And we're getting it now from the Mag 7, especially around the AI trade. But the rest of the market has actually been doing its thing and keeping up pace. So I know there's a heavy concentration of these stocks and we all overown them. And it's the heaviest trade in the market, the Mag 7 plus a few other stocks. But if you've been investing across the S&P 500, you've done pretty well at the same time. Good chart there from our friends at Carson Research. We'll link to it in the show notes. All right, let's get to our indicator of the week. And it's inflation related, of course. And we haven't really seen that many huge impacts on the prices of everyday goods when it comes to inflation yet. Yeah, you've seen it in certain areas, foreign cars, for sure. You've seen it in some of the metals that we import, but you have to go to IKEA to see real inflation due to tariffs taking effect. That's the Upland sofa there, the popular Upland sofa that so many first-time home buyers and young couples, I think we owned one of those when our kids were first born because you can destroy it. That was the Upland sofa, cost about $800 just about a month and a half ago. Now $999 at IKEA, which imports most of its products. And we know there's this new tariff on imported furniture and wood furnishings from the Trump administration. There's your proof of it right there. The Upland sofa now about 15-20% more expensive than it was just a couple of months ago. And let's go out on this because Blockbuster, the beloved video store where so many of us spend so much time picking out movies and hanging out in the 80s and 90s, October 19th, 1985, that was the day the first Blockbuster store opened. Right there it is in Dallas, Texas, and that changed the way we watched movies. We would go pick out our movies, pick out 2 or 3 movies for the weekend, bring them home, watch them with our friends and our family. You had to rewind. There was always a sign on there that said, please be kind, rewind. And most video stores only carried, I don't know, 20, 30, a couple dozen videos, but Blockbuster was Blockbuster. It was rows and rows of movies, and you would spend more time trying to pick out the movie than you would actually watching it. And ultimately, Blockbuster displaced by Netflix, one of the great business battles of all time. Blockbuster thought it had the market cornered by offering video cassette, but technology evolves, industries evolve, and Netflix market-corrected Blockbuster in a big way. And today, there's only one Blockbuster left in the world, and that is in Bend, Oregon. But I know a couple of people, including me, that still have our Blockbuster cards. So nothing gold can stay, but the price of gold continues to rise. Thanks so much for joining us, as always. Big shout-out to our friend Ric Edelman for rejoining the Express. I always learn a lot when I talk to Ric, and I think you will too. So we'll link to his old podcast, which he stopped at the end of last year, but there are volumes and volumes, and there's so many good episodes there, plus what he's doing at DAC FP and The Truth About Everything with Ric Edelman. Hey, Wanda, informative stuff. Thank you so much. Thanks for joining us, and thanks for your comments. Thanks to all y'all from around the world. What's the name of this speaker? His name is Ric Edelman, RICEDELMAN, and you can find him at Ric_Edelman on Insta, but also on LinkedIn. Make sure you follow him. Hey, there's the private banker official. We're talking banks this week. Thanks for chiming in. Hey, Ragaputhi, beautiful. Thank you. You inspire us. Thank you so much for tuning in. We love all these comments from our listeners, our live listeners around the world. And don't forget, if you didn't catch the full live episode, this goes up as a podcast on demand on your favorite podcast networks just shortly after we wrap things up here. So for all of you and for all of us, let's have a good week. It's going to be a busy one. Make sure you keep it between the between the lines, as they say, as we're driving down the highway or as we're riding on down these tracks, and we will talk again a little further on down the line.